Hello, YouTube out there. Wow, this is my very first video recording, and this video is for anyone out there who just wants to get a better view or idea about how the economy works and what's going on, and you know, and how will this all end and what's going to happen. And I have a lot of information in this video. I want to just listen to it. I draw my own conclusions about where things are going to go. And this is the result of 2.5 years of my own nearly daily research on the markets, the economy, finance, where everything's going in the world. And with all this crazy stuff politically and geopolitically and economically, what's happening now is just going to open up a lot of eyes and just really bring the people, the masses, to the forefront of what's going on. And this isn't meant to be a negative video. I'm not a negative person. It's just supposed to be a realist video about what the future holds and about finance and how just the global economy works. And you can see, just have a bird's eye view about what's going on, because this video, it will be it'll be eye-opening to some people, but for a very few small select people out there, this is going to be information that you probably already knew. Okay, the people who actually pay attention to their own research, they're going to know this. But I would say, honestly, for about 95 to 97% of the population, this is going to just clear up a whole lot of stuff. So that's that. This is my first video on YouTube, and the reason why I'm making this video is just for people out there like me. I'm a younger person, approximately 30 years old. I work a full-time job. I'll tell you what I do for anyone who knows me out there, but I work full time, and it just came to me one day, like, what is money? What is money? Where's it come from? How does it work? And just doing a little bit of research about a little stuff here and there, just putting it all together, it's really gonna be, it just made a lot of sense when I started my own research and putting it all together. So this video is to condense everything I've learned from one hardworking, middle-class American to the average Joe with maybe some kids or a family, what have you, and what could happen, what the future might hold, and where we're going. And like I said, this video is just to make sense for everyone out there, because the vast majority of people have no idea about anything that I'm going to present in this video. And maybe you do. Maybe you have interest in economics or some videos. Maybe you watch some Peter Schiff videos, or you watch CNBC and you're like, yeah, but you just listen to what the gurus, quote unquote, say. And everything you want to know is out there. You just got to have your own desire to learn about it and to put it all together. So, here we go. So I'm going to explain a lot of things. I promise I will break it down as much as possible. This will be a lot of information, but maybe a little bit here and there, or maybe it makes sense, or maybe a little bit, but this video isn't meant to combine everything you could have possibly ever thought about the economy in one video, all right? I don't know how long this video is going to be. I had a practice session about an hour ago, and I thought I was recording my voice, but apparently it wasn't. So here we go. Whatever. This time I know it's right, and yeah. So I also apologize in advance if I talk too fast. But like I said, leave a comment, and I would be happy to answer your questions and what have you. Okay, so we're going to go through all these tabs here at the top. I promise I'm going to make this well worth your time. I'm not a huge fan of just audio videos myself, but this is my own voice, and I don't want to do some boring robotic voice. And I have all kinds of tabs here I want to go with you guys. All right, so the first thing here is called the effective federal funds rate. And what this is it's just the Federal Reserve setting its interest rates, all right, in the short term. Okay? And so the Federal Reserve is our central bank, okay? And if you didn't know this, every bank in the whole country, okay, credit union, whatever, to get currency from the Federal Reserve, it's loaned into existence. All dollars are borrowed into existence. Now think about that. People see a dollar bill and they'll think, oh yeah, I got some money, awesome. Okay, but here's the thing, whether you realize it or not, that, let's say, $5 bill is actually $5 of debt plus interest. All right, and what is that interest? Right here, the federal funds rate. Okay, now that's kind of crazy. So here's what I want you to understand now. The economy, and this works for pretty much every single country in the world. This is not just the United States, but obviously I'm American. This is with the focus on the United States, but this is true for every country in the world. Okay, and no country uses a gold standard or anything like that. So every single country uses the same exact system. And what we see here is that these are interest rates, right? These go from 1955 till today, okay? So interest rates are set by the central bank, which in the United States is the Federal Reserve, all right? That is not the same thing as the federal government, all right? I may make a mistake and confuse the two, but I promise you that the Federal Reserve is not the same thing as the federal government, which is the Congress and the President and the Supreme Court, okay, or the judicial system, all right? So they're different entities. They have to work together, but they're very different entities. We do not elect the governors of the Federal Reserve. That's appointed by the President and confirmed by the Senate, okay? Excuse me. So it's a different system, okay? So the President doesn't have any direct influence on the Federal Reserve. So as I was saying earlier, the Federal Reserve sets interest rates, right, every single day. Okay, this is just what the, not seasonally adjusted interest rates going back to 1955. And you see a couple patterns here. So the shaded areas are recessions, all right, and everything that's in the white area is just a normal economic expansion. Okay, so you can see that first and foremost, what you should realize is that when we have a recession, the Fed lowers rates. Okay. So, for example, in 1969 here, we had 9% interest rates. Let's say, and this, by the way, affects everything, whether you want a car loan or a mortgage or a credit card or whatever it is. If you want to go into debt, you're going to have to pay at least, and probably more like 18% interest rates, honestly, because the banks have to make a nice little credit, a nice little profit off you. So, but this is just, like I said, it's just the Fed to other banks. Okay, you cannot get money directly from the Fed unless you're an investor and have lots of money. I don't think private citizen can. I don't know. I don't really care, honestly. It's not really relevant. What is relevant is that the Fed sets interest rates, and that everything in the whole country, economically speaking, if you want to have out a loan, it has to go through eventually, originally from the Fed. So in 1969, we had interest rates of 9%. And went to, say that recession from turning into a depression, the Fed lowers interest rates to make borrowing money cheap again. So lowered from 9% to 3.72%. And then you see we have an expansion, all right? Now you may be wondering, why does the Fed raise rates so much if there's no, depression or recession? Why do they raise the rates during an expansion? Well, it's simple. During an expansion, people spend more currency, right? It goes into circulation faster and longer. And, and that's a good sign of an economy. But when the economy overheats, like it did here in 1974, around Nixon, when he got impeached, or actually he resigned around this time frame, 74, we had a recession. And the Fed raises and lowers interest rates so that it stays on top of inflation, okay? The Fed does everything it can to maintain an approximate 2% inflation, okay? A little inflation is good for the government and the Federal Reserve because they both get money from the interest coming in, okay? So that's important. Inflation is good because it also shows that people are spending money and it's going to use, and people make more gains in the long term, blah, 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 blah. That's important. But if inflation gets too high, the Fed raises rates to stay on top of it, because if there is too much inflation, then you could have hyperinflation, like you had in Weimar Germany and the Czech Republic, Hungary in the 1940s, or Venezuela today, or Zimbabwe 10 years ago. You don't want hyperinflation, okay? It's really bad. It's just awful for everybody. The only people who really benefit, if at all, during hyperinflation are people who have lots of debt, because the debt becomes very, very easy to pay off. So that might be good in that aspect, but here's the downside. Everything from food to gas to medical to everything you possibly think of becomes ultra expensive during a hyperinflation, and everybody suffers. So it's really a bad thing. And the Fed doesn't want too much hyperinflation. But if you didn't know this, during the 1970s, we did have something called the stagflation, especially in the late 1970s, where you see interest rates went all the way up to 17%, okay, which is very, very high. And what this means is that there's a lot of inflation going on. So the Fed again lowers interest rates to 9 percentage points, is down from 17 to 9, or actually was that 17 minus 9, 8 percentage points, all right? But then, of course, it lowered it too low, and then you had another bubble, and then Paul Volcker, who was the Federal Reserve chairman, raised interest rates again to stay on top of the inflation, and then he caused another recession. And as you can see, interest rates have been slowly declining, okay? Now, you may be wondering, first and foremost, okay, that makes sense, but then why did it go up so much from 1955 to 1980, and why did it slowly go down to where we are today, all right? This is very simple. This has to do with something called velocity of currency. We call it velocity of money, but it's really velocity of currency, because that's what we use, currency, okay? And a velocity of currency just represents how many times a dollar bill is exchanged hands in a given time frame. That's all it comes down to. That's it. Okay? So let's say, for example, as a real short, simple, short example, example of that would be, let's say I take $5 bills, I buy an ice cream cone, and the ice cream maker takes that $5 bill and buys more, let's say ice cream cones with that $5 bill, and then the supplier, that ice cream cone maker, spends that $5 bill on wheat, okay, to make the ice cream cones, whatever it is, okay, or flour, something like that. So that's how I'll place a plate. So that'd be a velocity of 3. From me to the ice cream shop to the ice cream cones to the supplier. Okay, that's just a little simple scenario, and we can measure that velocity of currency, which again is again how much each unit of currency exchanges hands. But looking at this chart, the formula for velocity is your GDP, gross domestic product, divided by the monetary base. Well, that's just how many dollars are in existence. Okay, so think about it: GDP, gross domestic product, all the goods and services in an economy, divided by how many dollars are in existence, all right? And what you see here is that it slowly has been going up from about 1946 to 1981. And you can see after 1981 till today, it's been slowly going down, okay? Very, very slowly, okay? And if you have a very low velocity of currency, that means money's just not going anywhere. It's not being spent, it's not being used. And it hasn't really gone above 6, 7, let's say 8, since 2009, all right? And notice here, this goes all the way back to the Great Depression. In the depths of the Great Depression, where we had only 9, okay, it's actually lower today. How crazy is that? Since 2011. So that means money was moving faster during the Great Depression than it is today. But wait a minute, you think about that, and you want to say, well, how is that possible? We're not in a depression, all right? Everyone has a job. Unemployment's at 4%. What's going on? We got Trump as president. How does this make any sense? It doesn't make any sense at all. All right, well, here's why. Because all they did to offset the Great Depression that we would have had, the second Great Depression, I guess we'll say, was they inflated the monetary base, okay? And notice this is in millions of dollars. So we have here in 2008 almost $1 million, or AKA $1 trillion, okay, trillions. And notice, this goes all the way back to 1975, but it doesn't take a rocket science genius to figure out, wait, before 75, we never had a hyperinflation except the continental dollar after the Revolutionary War. We have never had a hyperinflation in the United States because we've always had some form of a gold standard or silver standard, all right? Even with the Federal Reserve coming into existence in 1913. We've had a very, very slow and steady increase in the currency supply, okay, our monetary base, okay? But then we had the crisis of 2008, and you can see here again, look at velocity. It just falls off a cliff from 17 down to just 4 at the low in 2014, okay? It just falls off a cliff, okay? So look how low this is, even compared to the Great Depression. All right, and this is just data that's available for public knowledge, guys. This is out there for you. I'm not no insider. I promise you. I'm just an average Joe on the street. I just like knowing the truth. I do a lot of research. It's what I like to do. I have a couple other hobbies, obviously, my work full time, but this is just what I love to do, and I love talking about it because I want people to understand this is how the economy works, and this is what the central bankers don't want you to know. They want you in the dark because they want to say, oh, this is all too complicated. Well, you know what? It's not, because like doing myself, I found all kinds of resources. I'm looking out here for just the average Joe, putting it all together. And I promise you, you're going to have a whole different view of our system and everything once you're done with this video, if I don't bore you half to death. But, you know, if you like money, you want to learn about how everything works, hey, please, welcome. Thank you so much for listening. All right, so anyways, so this is velocity. And you can see it peaks in 1981 here. Okay? Oh, how interesting. Velocity of currency peaks in 1981, but so does our federal funds rate. Oh, how ironic. And then it slowly goes down, and then we have zero interest rates, mostly zero, essentially zero interest rates, after 2008. Okay? Zero interest rates. So this is when we had 0% interest rates, all in this little time frame, right? Where velocity is dead. Money is not circulating. And all they did was just inflate the currency supply here. See? So does it make sense now that you have not seen any depression or deflation or hyperinflation, right? Because in 2011 here, everyone's saying, oh, hyperinflation, hyperinflation. The Fed's printing all this money and it's going to be terrible. We're going to have a massive hyperinflation, so buy your gold and silver and blah, 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 blah. And that didn't happen. Nothing happened. Okay? And I'm going to explain why, which is simply, now you know, velocity of currency. And the Fed doesn't want you to know this. You know, you have to do the math yourself. GDP divided by monetary base. You could do their own M2 monetary supply, velocity of money, but they don't want you to know this. They don't want you to know what's fallen off a cliff since the Great Recession. They don't want you to know that because they want you to think everything is just fine. You know, Bush and Obama and Trump, they all fixed everything and it's okay, nothing to see here. Well, nothing could be further from the truth. We just haven't had our day of reckoning that yet. And like I said, I'm not a negative person. This is all just the truth. And you can see it here for yourself. I'm not making this up. All right, so you see monetary base. Okay, they hyperinflated it. Now let's put it all together. So this is the rates that we saw from the first slide. Okay, you see it goes up, it goes down, etc. Then you have the red line here, which is the Wilshire 5000. And by the way, these figures are manipulated, so I just want you to understand that. This is just to show patterns, okay? And it's not supposed to correlate anything, just a general pattern, all right? So you see the red line, that represents stocks. That's the Wilshire 5000 market cap. Okay, all the stocks. And then the green line, ironically enough, is the dollars in existence, and the blue line is interest rates, okay? And what you can see after the Great Recession right here in 2008 is that with 0% interest rates, they inflated the monetary supply, the green line there. But ironically, you see stocks, the red line has also gone up. And what do they tell you to always to invest in? What? Stocks and bonds. You don't invest in real estate. I mean, you could if you want to, but now I think it's a bad time for real estate. You don't invest in precious metals. That's for the crazies. You don't invest in, foreign, whatever, bonds. It's all about the U.S. stock market, good old America. But you just see that something doesn't look right. That doesn't look natural, right? You can't. It's an impossibility for these to be correlated. And I want to just throw a shout out to Mike Maloney because I got this website from him a long time ago in 2016. So shout out to him. He also was a great influence to me. So thank you, Mike Maloney. You can search his YouTube channel. He's the founder of goldsilver.com. So I want to give credit where credit's due. But you can see here that stocks have been really hyperinflated, right, since the Great Recession. And that's because of, like I said, the easy monetary supply. Now you may be thinking, okay, that's fine. So what? Okay, well, here's why it matters. This is called the Shiller PE ratio. And what this measures is the earnings of a stock versus its price in the stock market. Okay, and I hope you all know stocks are just shares of a company, right? Let's say company A makes a lot of money. They're getting very popular. It's a household name. Their share goes to the roof because everybody's excited about where it's going to go in its future, right? So they buy its stock. And the company's more profitable and the stock price goes up and everybody makes money, okay? Stocks are great. But like every asset, it can go into a bubble. Everything can go into a bubble. And what is a bubble? A bubble is just when you have an asset, whatever it is. It can be anything, whether it's cars or real estate, bonds, stocks, anything. Tulips, if you know what that is. Google the Dutch tulip mania. That's an interesting story for you. But what I'm trying to say is if it's an asset, it can go up into a bubble when everybody thinks it's going to go up. And that's exactly what we had in the 20s here. So you can see, and then by the way, this chart, as you can see, goes all the way back to 1880. Okay, and it's inflation adjusted, right? This is the inflation adjusted PE ratio for the S&P 500. So the price to earnings ratio is based on the average inflation adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio or CAPE ratio, Shiller PE ratio, or PE10. Okay. So after World War I, we had a little bit of a depression here. It wasn't like the Great Depression, but it was a sharp and painful depression for like a year and a half. I think a year and a half it was, all right? But then you see we all came back and the Fed came in and lowered rates, and then there was the Roaring 20s where you had prohibition and, you had all kinds of new inventions like the radio, and you had automobiles, the Model T going to full line production, and there's a lot of good things happening in the 20s, some bad things too, but a lot of really rapid expansion of the economy. Everybody was super optimistic. America just won World War I. What do you want to get involved? We were there, I think, for only like a year and a half or so in World War I, fighting in Europe, and everything was just going great. Until everybody was thinking, wait, go buy stocks. You had the teacher in the stock market, the store clerk in the stock market. Everybody's in the stock market, right? It was always going to go up. You can't go wrong. Everything's going great, all right? But the thing was, there were some warning signs before the Great Depression, In 1929, car sales were going down. Herbert Hoover just got elected president in March of 1920. Well, actually, he was sworn in 1929, March. And he had a giant bubble form. And then the bubble, everyone knows the crash of 29. The stock market, or the Dow Jones, actually, SP, you can measure the S&P 500 too. But the Dow Jones, I know, lost 89% of its value from its peak in September 3rd, 1929, to the very bottom in 1932, where it went from 380 points all the way down to just 41 points, I think, in 1932. And that's an 89% decline, all right? And it took 25 years, literally, it took 25 years to regain that from that 32, or no, sorry, it was 41, the low of 41 points on the Dow in 1932 to go above the 380 high, in 1929. All right, and that was in 1954, all the way over here. So think about that. Think about that. If we had a crash today and it took you 25 years from today just to regain where you left off, all right, that's 2.5 decades of lost gains. Like, that's terrible. So this Shiller PE ratio can tell your gains in the long-term future, all right? So you can see that, it's actually went to 32 in 1929, but this chart says 30. It was actually 32, but it's not a big difference. All right, you had a little mini bubble in 1966, but then you had some inflation of the 70s. You had the stagflation in the early 80s, late 70s, and, in a real basis, inflation-adjusted terms, stocks, even though they look like they went sideways, they actually went down, okay? And because, again, everything has to be inflation-adjusted, so it's all about inflation, right? If you have $100 a year ago, 10 years ago versus $100 today, you could buy more stuff 10 years ago, okay? Because that $100 was worth more. So remember, I just showed you the chart, they're always inflating the currency supply, right? This is why saving in currency is a bad idea, because they always print more of it. And they can certainly manipulate anything they want to offset anything that they don't want you to see, okay? So this Shiller PE ratio, it just tells you the inflation-adjusted stock prices. And you can see in the 90s, we had a massive boom, the tech boom in the 90s, that crashed. So the S&P 500 lost 50% of its stock value. We had the great financial crisis in 2007, 2008. Even though, ironically, believe it or not, the S&P 500 at these 2 points, they're actually almost the same. But again, it's all about inflation. So they both topped at about 1540, I believe, in 2000, like January 2000 and October 2007. Look at the difference here. The same numerical value, inflation adjusted, very different. And notice that since we had those 0% interest rates, our stocks had been higher than they were during the Great Depression, or the 1929, right before the Great Depression. So what does that tell you? Again, it just shows you further proven evidence that the stock market is completely overvalued. It is completely unsustainable, okay? I mean, you can just look at a chart of the S&P 500. You tell me, does that look sustainable to you? I mean, Google it. I dare you to Google the S&P 500, chart, stocks, and you just look at the last, 30 years, and you can just see it from 2009 onward. It just goes straight up. It's not sustainable, So I hope now at this point you're in agreement with me that, yes, stocks are in a bubble. Stocks are probably not the best asset to invest in, even other, I know you can watch CNBC all you want, but they're going to always have a positive spin because no one wants to be doom and gloom. But, it's not about being doom and gloom. It's just about, this is the world we live in. It's just the way things are. So please understand that. Okay, so now we're going to talk about a different asset. And the government, the central bankers, they don't want you to buy precious metals, okay? They tell you, even Warren Buffett, they're like, don't buy precious metals, it's a dumb idea, blah, 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 blah. Well, here's what they don't want you to know, okay? This chart right here is the gold to silver ratio. It tracks how many ounces of silver you need to buy 1 ounce of gold, all right? And this is from Macro Trends. They do a great job here. And this goes all the way back to 1915 to today, all right? And by the way, if you didn't know this, it was actually illegal to own gold from 1933, when we had FDR sworn in, to all the way to 1974, I believe it was. It was actually illegal to own gold and silver till, I believe it was Nixon who ended the gold standard in 71. He's like, okay, the dollar is not going to be pegged to gold anymore. If you didn't know that, yeah, that's also a nice little tidbit you should know. Before 1971, the U.S. dollar was literally as good as gold, okay? Until Nixon said, we can't do that, And by the way, before 1964, if you didn't know that, that pretty much every dime, every coin was 90% silver, 10% copper. After 1964, under President Johnson, he decided to take silver out, and now we have something called cupro-nickel coins, where it's like a nickel coin, a copper coin that has nickel wash. And if you don't believe me with that, take any quarter, look at it from the side, and you will see half of it's brown from the copper, and half of it is silver from the nickel. But it's not silver. So, all right, anyways, I digress. So, the higher this chart is, the cheaper silver is, or the more expensive gold is. So, the lower value of this chart is, the higher silver and gold and silver are in terms of price. Okay, and it offers you a great historical perspective of how silver and gold are priced. Okay, and you can see pretty much after the Great Depression, World War II, that silver and gold were very expensive. And by the way, they were money, technically speaking. Literally, gold and silver were money. Okay, until Nixon ended it in 71. All right, and you can see we had the inflation, the hyperinflation, the stagflation of the 70s, and then you see this tank in 1979, 1980, when ironically gold and silver peak. Gold peaked at $850 per ounce, which inflation adjusted into 2018 dollars, that would be like about $2,200 per ounce. Silver topped at $50 per ounce, also partially thanks to the Hunt brothers trying to corner the silver market, but they failed. But they brought silver from, I believe, like $5 an ounce all the way up to $50. So that's 10 times the earnings you could have made if you bought silver in the early 70s. Just be aware of that. And they say, oh, don't buy gold and silver. Oh, that's not an asset. Well, yes, it is an asset. Okay? And where we're going, which I'm trying to prove to you all in the video that I'm making right now, is that it's a great asset to own today. Okay? So, here's what we have. So you have gold and silver here. They peak in 1980, but like I told you, Paul Volcker and the federal funds rate, they squashed that inflation to be on top of it, because too much inflation is obviously miserable. It's bad. It's horrible. You have social unrest. People are going to start protesting. And then you had, Ronald Reagan elected in 1981. Sorry, no, election 1980. He was sworn in 81, and his campaign slogan was "Make America Great Again." I feel like I've heard that before. And pretty much with the Fed's, it's actually the Fed, not Ronald Reagan, but the Fed, got on top of inflation. You can see it slowly went down from the 80s. That doesn't mean by the way, that does not mean there has been no inflation since the 80s, because there has been. In fact, $20 in 1980 is worth about 64 in today's dollars. So there has been inflation. It's just been slow. And the Fed has been trying to hold off the inflation. And like I said, the Fed likes to have about a 2% inflation rate, about 2%, because it's low enough where people can't really feel it, but it's enough where they can make some money without going through Congress. I don't know if you knew this either, but think about it. If the Fed has inflation, they get more money, or currency, in return for people using it, because every time money is spent, currency is spent, Uncle Sam and the Fed get a little bit of tax income. So they want inflation, okay? They want people they want currency to, go around. So that's that. Anyways, you can see the economy did pretty well since the early 80s. Stocks have been in a very much secular bull market, especially since the 80s, and bonds the same way since the early 80s too. And you can see that gold and silver were very, very undervalued in the early 90s. Very undervalued. But then you had a stock market bubble forming, especially since 1995, and you see gold and silver get more expensive because during really good times, inflation's going up, and then of course the price of gold and silver go up. All right. Then you had that implode. The Fed lowered rates here in the early 2000 recession. All right. Gold and silver got a little more expensive again. Then you had the recession of '08. Everything got really cheap because we had a recession, but we almost had a depression actually. And the Fed started printing all kinds of money, currency. And then everybody's afraid of hyperinflation. In 2011, you see it just, bottom here. And like I said, the lower this chart is, the more expensive gold and silver are. Okay? So in April 2011, silver topped at $50 per ounce, which I'll show you in the next tab. And gold topped at $1,900 per ounce. But you can see since 2011, this line's gone up again. The gold and silver ratio have gone up again. So we're back up to 80 here in March 2016. Went down a little bit, remember in the summer 2016, silver went up to $21 per ounce. But right now today, with a gold to silver ratio about 81, I know silver is like $16.41, and gold is like 1,320. So, okay, so well off their 2011 highs. All right, so please know that. Now let's look at the price of silver. All right, and this is not inflation adjusted. Okay, it's not inflation adjusted. So this was the actual price of ounces, actual price of silver per ounce, okay, since 1917, all right? Now I'm going to make this inflation adjusted. And again, this information is brought to you by macrotrends.net, great website, all kinds of good stuff on there. If you haven't used it before, I recommend you check it out. But you can see here that when you adjust everything by inflation, because remember, inflation's everything, especially dealing with long-term trends. Like I said, right now, silver, February, March 2018 is about $16.41 per ounce. All right, inflation adjusted, you can see that silver is cheaper today than it was in 1973. How crazy is that? That is 40 years. 40. And, that just doesn't seem right to you, right? How can an asset be cheaper today than it was in 1973? Does that make any sense to you? That doesn't make sense, right? Because we've had inflation since then. So you can see silver is an incredible bargain. Just looking at the price wise of it, it's a good bargain. This isn't even talking about any of the economic stuff, the negative stuff that I want to get to in a second. But you can see that right now silver is a great value. I mean, what can you buy? I mean, think about this for a second. What is cheaper today than its 1973 price? I mean, I promise, I dare you to find something and give it to me. I dare anyone to find anything that is cheaper today than it was in 1973. Please do so. Okay? And if you look at this pattern here, it forms something called a cup and handle pattern. I'm going to make this not inflation adjusted. Okay, so this is the actual price. It was $35 per ounce in 1980. It actually went up all the way to $48 per ounce, by the way. It's actually like a couple days in March, I believe it was in 1980. It was all the way up here where the cursor is. So just know that too. And what you see here, it forms a giant cup and handle pattern. And I'm going to show you this article by Kimball Charting Solutions. Great article. And you can see that it's the same chart I just showed you, non-inflation adjusted. So you see in 1980, it shot to about $50 per ounce. It went down, formed a cup-like shape, went up to, let's see, in 2011, it went up to $50 per ounce, and then it's retreated a little bit. All right, went up a tiny bit in 2016, but then it's been going back down. So this is the giant pattern it's showing. It says multi-decade cup and handle bullish pattern. Break above 1 would be bullish for silver. All right, and this looks like it goes to 2018. But notice that we are in a new bull market because it has not gone lower than the 2015 lows right here. I believe it was $14 per ounce for an ounce of silver. Right now it's about $16.41. It's not a huge difference. What, it's $2. Okay, that's fine. But the point I'm trying to show you guys here watching this video is that silver is being set up for an absolute, how should I say this, rocket launch pad of an explosion in price. Okay, because if you want to Google it, again, Google cup and handle pattern. It's very, very bullish for silver. For anything, actually, any stock, any chart you want to find, just go to Google Images, cup and handle pattern, and you can see it's very bullish for any asset in that pattern. So you can see what's happening here. It's going to go up. There's another article I wanted to show too. Actually, where is one more? Oh, there's one more I wanted to show you. Actually, I'll show you Investopedia. That's a good article. But you can see here that it's any kind of pattern. By the way, this little pattern here is like, what, a couple months? I mean, we're talking like decades. I mean, this is from the 1970s it started. Okay, so you know that in the future, silver is going to go way above this 100, and again, this is inflation adjusted, way above this $110, $12 per ounce. Inflation adjusted, okay? So that means silver could be, I don't know, $150, $200 per ounce. That's just a bare minimum. I was just looking at this, at the technical data. Okay, and I'm going to show you how, very soon, how the economy is going to support silver soon. Okay. So, it says, as a stock is forming this pattern tests old highs, it is likely to incur selling pressures from investors who previously bought at those levels. Selling pressure is likely to make price consolidate with a tendency toward a downward trend for a period of 4 days to 4 weeks before advancing higher. A cup and handle is considered bullish continuation pattern and is used to identify buying opportunities. So below is an example of a cup and handle chart pattern. All right. So it's worth considering the following when detecting cup and handle patterns. Length, generally cups with longer and more U-shaped bottoms. Looks like a U-shaped bottom to me. Provide a stronger signal. Avoid cups with a sharp V bottoms. No, that's not silver. Depth. Ideally, the cup should not be overly deep. Avoid handles which are overly deep also, as handles should form in the top half of the cup pattern. All right, that's what you see here. Let's inflate. Top half of the cup pattern. So we had a low of like what, what's it, like $6? Right now we're at 16. And the high is 50, so half of that would be like what, 25? Okay, we're in the top half, that's for sure. Ish. Let's see. Volume should decrease as prices decline and remain lower than average in the base of the bull. It should then increase when the stock or whatever asset begins to make its moves higher, back up to test the previous high. A retest of previous resistance is not required to touch or come within several ticks of the old high. However, the further the top of the handle is away from the highs, the more significant the outbreak needs to be. So all that's saying is this is going to go up. Okay? And gold's the same way too, but as I showed you earlier, the gold and silver ratio shows that silver is a better value. This is gold price. Let's just do this. So same thing. Inflation adjusted. So here we go. It hit what, 2000, almost $2,200. Went down. Volume, people weren't interested. Everybody hated gold in 2000. The stocks are all-time high. S&P lost 50% of its value. Right? We had the crash of 2008. People feared a hyperinflation in 2011. The Fed interfered with their quantitative easing policy, printed trillions of dollars to fill the hole. And you see silver still in the top half. So, and it goes without saying, if gold goes up, then obviously silver is going to go way up. Okay, silver is like I said, you're going to make way more money from silver than gold when this happens. Okay, so there's that cup and handle pattern. All right, next thing I want to talk about are kind of coincide with all these interest rates. So I went from interest rates talking about gold and silver, and the reason why I did that is because, like I said at the very beginning of this video, interest rates control the entire economy. And what you can see here since 2008, December 2008, is that interest rates have been very, very low. And everybody's known this, right? This is no secret. Everybody's known, oh yeah, interest rates are so low historically. Now's the best time to buy a house, blah, 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 blah. Yeah, okay. Well, what cost does that come at? Okay. You have to understand something that, let me go back to this slide here, is that investors will, banks and what have you, will go into debt for more, stocks or what have you, get more debt if they know that they can get a return on it. All right. And the Fed wanted to really stimulate the economy after the 2008 financial crisis. So interest rates went to zero. Okay. Now there's something really important here, that there's something called the Treasury yield curve. And if you didn't know this, the Treasury yield curve, well, you know that the government is funded by debt, right? That's why it doesn't matter who the president is. The government is always funded by debt. So, and how to fund the debt is by interest rates, okay? Because I told you before that every single dollar that exists is debt, okay? And all debt has an interest rate to be repaid, right? Because no one gets in debt for free unless you're Big Bang from the Federal Reserve after 2009. But even now, interest rates are like 1.4%, and that's not sustainable. But regardless, what I'm trying to say is that there are different kind of yields for a Treasury bond. There's a 3-month maturity. That means you give the Treasury Department, X amount of dollars, and in 3 months you get your money back plus the interest you will have earned, right? Makes sense. In 1999, we got like over 4.5% interest rates from a 3-month Treasury bond. Okay, and it makes sense that the longer the bond is, let's say 2 years, 5 years, 7 years, 30 years, you're going to get a higher interest rate. Okay, that makes sense, right? Logically, if you give somebody your money as like a loan, right, you're going to want a higher interest rate in the long term for them holding your money longer, right? So you can see here that we call a normal curve when the short-term rates are lower than the long-term rates. It makes sense logically, but sometimes that's inverted. Okay, and what would cause that inversion? Let's see, it's inverted here. You see in August 2000, and the 3-month yield was like, I don't know what that percentage would be, but just under 7%. Okay, for a 3-month yield bond versus a 30-year bond. Okay, and think about that. When would you not want someone to hold your money long term, but you rather have a higher return interest on the short term? Well, you do that when you expect the long term to not be so positive. It's going to look bleak, okay? And you can see every time when the Treasury yield curve is inverted, like it is in here, you see everything kind of go downhill. And what they do, the Federal Reserve lowers interest rates, and you see the Treasury yield curve go normal again. All right, this is a great site, by the way, from stockcharts.com. And you can see 2003, everyone gets optimistic again, and then everything's going great till the Fed raises rates too high, and you see it invert again. All right, and then you have the subprime mortgage crisis, and then you have the great financial crisis, and then interest rates go to zero. Notice here that and you saw this big chart here, right? Notice again, we'll do the last 10 years. Since 2000, this is crazy, it's only 10 years. Since 2009, we've had almost 0% interest rates, okay? And this is how that plays out. Look at the short-term interest rates, right? They almost right near the bottom there, like almost nothing, because the Fed's not going to give you anything for it, right? Because you know the Federal Reserve and the Treasury, they compete against each other in terms of interest rates. Because again, the entire economy is all run by debt and credit, okay? And you can see that no interest rate has been changed. Everyone's pretty, wants their money for the short term. They don't trust the situation, but long term is actually pretty decent, So 30 years out, they want a good return. That makes sense, okay? And what I want to say earlier, by the way, is that every time it's inverted, a recession's almost guaranteed imminent, sorry. Oh, I can't talk anymore, my bad. But anyways, yeah, so you see this normal curve here, all right? And as they slowly been raising rates, very slowly, since 2015, went from they jacked it up by a quarter point or 25 basis points, up a little bit more, and now you're at 1.4. Okay, so you can see that change just from 2016. Look at short-term interest rates in that picture here. All right, this is one in 2016. You see the short-term go up right here? Look again. You can just look at that as they go through it. You can see it go up. And that's a result of the Fed raising interest rates. Okay. The point is the Fed doesn't want the curve to invert. Because you can see here, by the way, this is the 10-year Treasury bond minus the 2-year Treasury bond. Okay. And you can see is that every time it goes below zero here, there's a recession. Because then you see this become inverted. There's a good example. Like right here. This is flat, it's really inverted. Right here. Yeah. So you can see the 3-month is way higher than everything else. So, and that's what the Fed doesn't want. The Federal Reserve does not want this to invert. They don't want this right now to go like this. Where is it? Like right here. Okay? Because that says, uh-oh, investors are starting to get scared. We want our money back soon with a higher yield than the long term. Because that shows like they're, skeptical about the future holds. So they don't want this to go below zero. Now, the Fed has incredible power to manipulate the markets. And let's see, 1994 here, it almost went below zero, but then they were able to raise rates a little bit. And they're able to forestall that inversion. But eventually happened in 2000, then you had the crash of the S&P 500. So, they can't do it forever. And it makes sense. You can't have 0% interest rates forever. You can't. Eventually, people are going to want their money back at a higher percentage rate. So, or you're going to have massive bubbles. But we know we already have that, right? Because, look at that. Does that look normal to you? I don't think so. So, they don't want to invert this. But look at where we are right now today. We're not below zero yet. But it doesn't take a rocket scientist to figure this out, that, by 2019, 2020, what's going to happen? It's going to probably invert soon. And then we might have a recession. Now, no one knows. It might go fast, like right here. Jerome Powell said he wants to do 3 rate hikes this year. Probably another one was in June, another one in probably September. Who knows? But again, the Fed has to react to the bonds, the bond market. Because the bond market, they have no control of. They can only affect the interest rates. So if, let's say, bankers don't trust where the world's going, they want higher yields and a lower bond price, because bond price and yields are inverse, right? So let's say if you want, like 4% interest on a bond, the price goes down, because that makes sense. If you don't want the bond price to go up, you want a higher interest rate to compensate for that. I know this is a lot of information. It took me, like I said, 2.5 years to really get this down myself. But that's what's happening. So, but here's also the huge thing I want you to understand too. When this inverts, okay, there's going to be a recession. But look the big picture here, all right? At all the interest rates, it takes at least about 5% interest rates, right? 6.5% all the way down to 1. 5% interest rates to fight off a recession. we're only at 1.4, percent interest rates. If we have a recession, the Fed is literally out of ammo. I mean, what are they going to do? They're going to have to go negative on interest rates. What's that going to be like? Switzerland and Japan, I believe, have negative interest rates they've had since the Great Recession. But that's not sustainable, and it's just the whole system it's just crazy, corrupt nonsense, and it's just not going to end well. And it's not me trying to be negative or anything like that, but this is just the picture of the reality we face. So, I'm just trying to say, look at the gold silver ratio, look at silver prices, look at gold prices. I hopefully convince you that the stock market's overvalued, on a historical 140-year basis. And just based on the fact we've had 0% interest rates since 2009, 2008. And it's just, the rates have to go up like they did in the early 80s. It's just inevitable. It's not going to happen tomorrow. There's not going to be, riots in the streets. I'm not saying that. But what I am saying is that people need to be aware of what's going on and what could happen in the future. So I say now's the time to get prepared. We've already had a little bit of a crash in the market let's say, in early February, late January this year. In 1928. Here, I can pull up a chart for you guys. Let's see. There's the one I did want to show you. So was one I wanted to show you in 1929. You can see here that okay, so this is the chart crash 1929, all right? This is a great little chart right here. And you can see that, the market went up, you had a low crash, regained, and then you had like a pretty much sideways chart in 1929. Then it went up into a bubble, and then you have a classic head and shoulders pattern, which is extremely bearish, which, came collapsing down in Black Monday and Black Tuesday, October 28th and 29th, 1929. So, that may happen today. I don't know what's going to happen. No one can see the future. But what I can tell you is that what's going to happen next is going to be nuts. I'm trying to be very apolitical, but you can make your own judgments about what's going on in the federal government today. How long is that going to be sustainable? Who knows? But again, I'm just doing this for the good of humanity, to say, hey, look, this is what's going on. It may not end well. Do your own research, form your own conclusions, but just be prepared and understand that this is what how our financial system works, and this is how the government reacted to it, the Fed and the Congress. And as everyone knows, that we have lots of debt. $21 trillion of debt. This is a great website, by the way, if you haven't seen it, usdebtclock.org. It's all true. And I like this part the most, silver. Year-over-year increase in the U.S. M2 money supply divided by the yearly world production of silver in ounces. That means silver should be $600 per ounce. Oh, by the way, one little factoid I forgot to mention about that gold and silver ratio, how it's 1 to 80, as in like 1 ounce of gold buys 80 ounces of silver. Yeah, out of the earth, because you can't make an element, but out of the earth, silver is only mined 9 times more than gold. And you can, by the way, feel free to research that and double check me, but I guarantee you can say, yeah, I'm right. That's actually right here too, if you want to see gold, precious metals. Tells you production, right? If you want to do the math, right here. So this is world precious metals production 2018. Sorry, gotta get that back. So if you divide 226, 478, let's say 650, divided by 26, 899, let's do 780. Okay, yeah, 8.1 times. So, less than 9. So then please tell me, how was there only 8.4 ounces of silver mined out of the earth for every 1 ounce of gold, but yet the price is 1 to 80? I mean, does that make any sense to you? I don't know. I don't think so. Personally, no. So, use your own common sense, use your own knowledge. I hope this video was eye-opening to you. I just want you to understand that this is how the system works, and maybe that everything makes sense to you. And hopefully, I bet you a lot of financial advisors don't know half this stuff. But again, this is all my own research and my own looking at different channels on YouTube, listening from everyone from CNBC to Mike Maloney to Dave Morgan to all kinds of perma bears and perma bulls and all kinds of stuff. And this is just how the economy looks and how it functions. So If you like this video, please give me a thumbs up. My first video ever, and I hope to see you around soon. Thank you. Goodbye.